Hey everyone, this is Kirk here again from OptionAlpha.com, and in this video tutorial I want to talk about a covered call spread. So covered calls are for the long-term stock investor that is definitely looking for a steady or slightly rising stock price, at least for the term of the option. Now this is generally a capital intensive strategy because you have to be long at least 100 shares of stock to sell a traditional covered call. And really, this is where most people get started in making the transition between options and strategies and kind of moving away from trading stock just by itself and using some options and strategies in conjunction with stock. And I definitely agree that if you're going to be a stock trader and stock investor, you've got to have some sort of covered call strategy inside your portfolio because it's just the smart way of making trades. So let's talk about how you set up a covered call specifically. The first thing that you're going to do is you're going to be long 100 shares of stock, or you're going to buy 100 shares of stock. Now, in this case, you may already have 100 shares of stock. So in that case, you already kind of meet that requirement. But if you don't have those shares of stock, you do have to buy 100 shares of stock to do this strategy. Again, this is why it's a little bit capital intensive when you get started. Once you have those 100 shares of stock, you can sell one out of the money call against those positions or that position of stock. And basically the reason it's called a covered call is because that one option covers 100 shares of stock. So now your position is covered on both ends. So what's the risk? Well, because you are still long 100 shares of stock, your risk is still in the decline of the stock past your new break-even point as it heads lower. So selling the call option helps reduce the cost basis on the shares that you own. This is really the main benefit to doing a covered call strategy, and one that we've talked about a lot both in our blog and in our podcast, that it reduces the cost basis on the shares that you purchase and actually leaves you a little bit of wiggle room for the stock to move down and still make some money between now and expiration. And we'll show you a good example of that here in a little bit. As far as profit potential, covered calls do have a limited profit potential to the difference between the strike price and the stock price plus the credit received from selling that out of the money call. Now, although these are limited in profit potential, they make up for that in a higher chance of success overall on the trade. Again, because we're moving our break-even point lower and our cost basis on the trade lower, this gives us a greater probability of success overall going forward. Since we are short a naked option and the stock is not affected by volatility, increasing implied volatility generally does hurt this position. And what that means is that we want to try as much as we can to target this strategy when implied volatility is really, really high in the underlying stock that we're trading. And this gives us the best edge in the market. As far as time decay or theta, the passage of time as we generally get towards expiration does help this position since we are short premium that we received on the sale of the call. So the closer and closer we get to expiration, we ideally want to keep all of that premium that we received on the call option, and the closer we get to expiration, the faster this will materialize. As far as break-even points, they're very easy to calculate. You basically take the long stock price minus the credit received on the sale of the call. This is where we reduce the cost of owning the stock by selling a call again. Now, we're going to take a look at an example here using the stock ticker symbol USO. And USO is basically an exchange or an ETF that trades and tracks an oil fund for the US. And so again, that ticker symbol is USO. The stock's been really beaten down recently as of the time of this video. It's down around 1777 as far as a price. That's where it kind of closed today. So when we go in here to do our covered call, the first thing that we have to do is own the underlying shares of the stock. Now, in this case, we don't own the stock, so we're going to go ahead and buy the stock again at that price of 1777 where it closed today. And we're going to buy at least 100 shares of stock. Now, this creates a lot of capital requirement in our account because we have to cover that trade, but this is how we build that covered call. The next thing that we're going to do is we're going to try to sell an option that's out of the money. In this case, we're just going to go ahead and sell the next nearest option out of the money, which is the 18 calls above the market. Now for those calls, we should get about $1 for those once the market actually opens up tomorrow. So we're going to go ahead and place that order here for about $1. Again, it's about 2 pennies higher than where it closed today. So that 18 call then helps reduce the cost of owning the shares by $1, which is that credit that we received. Now, when we look at the payoff diagram here, you can see it looks just like the one that we had in the slides before. It's got this steep angle on the left side. This is basically where you own the stock. This is kind of your stock profit and loss curve. And then it flattens out here right at the strike price of 18. So you can see that strike price of 18, this is where it flattens out because you sold a call at 18. You are capping your profit beyond this point. You can't make any more money should the stock go higher. But now the benefit to doing that is you cap your upside potential in this trade, and you're capping it to about $110 in this trade, is that you move your break-even point down or lower from where it's at right now at $17.77. You move it down by a whole dollar. So in this case, USO can actually fall another $1 and you still would be okay at expiration. You wouldn't make or lose any more money than you do right now. If USO fell less than $1, then you actually still make money at expiration. And if USO moves higher, you still make money at expiration. So this is why when trading covered calls, it's so important to realize that that reduction in cost basis, or the reduction in the cost of owning the shares, using that credit to offset that price, helps you in your increased probability of success. And most people don't get that concept, but it's so critical to your ability to do these long term. Now, one of the key takeaways that we have for covered calls is that you should always remember that if the stock should move past your out of the money call strike at expiration, in our case with USO, it would be moving past that 18 call strike, you will forfeit your stock to the other party in the transaction. That's why it's called a covered call, because you are covering that trade with the shares that you already own. So in that case, the shares will be taken directly out of your account and you'd have to rebuy the shares at some price in the future. But again, that's okay if that happens, because that means that the stock made a huge move and you've already banked a profit anyway. You just didn't realize all of the profit from the stock moving higher. We personally don't favor these strategies because of the higher capital requirements. We think that there are other ways that you can get the very same profit loss diagram and the same risk reward features as doing a covered call, but with a lot less capital on the line. And so again, that's one of the ways that we use and teach options inside of our membership area at optionalpha.com. Even though this is a great strategy for long-term investors, we feel that there are better ways to make money trading this same profit loss diagram with much less capital. As always, I hope you guys enjoy these video tutorials. If you have any comments or questions, please add them right below here in the lesson page. And until next time, happy trading.